ready to cut through the complexity of modern investing. We are often told that true diversification requires a sprawling portfolio of dozens of assets and funds, demanding endless monitoring and huge capital. But what if I showed you how to build a rock-solid, globally diversified foundation using just 3 simple low-cost exchange-traded funds, ETFs? The concept of simplicity in investing really appeals to me, and I think it can to you too. We are often led to believe that the key to a successful investment portfolio is having a vast array of assets, but what if I told you that's not entirely true? What if you could achieve a genuinely diversified portfolio with just a handful of ETFs? Many investors, especially those just starting out, can get overwhelmed by the sheer number of options available. I mean, think about it. You've got individual stocks, numerous bond types, real estate funds, commodities, and much more. And within each of those asset classes, there are countless specific products to choose from. It can be truly paralyzing. This complexity often leads to analysis paralysis, preventing potential investors from ever beginning their journey. New investors might spend so much time trying to decide on the perfect blend that they end up delaying investment entirely. And that's a huge missed opportunity, because consistent investing is one of the most effective ways to build substantial wealth over a lifetime. The idea of using just 3 carefully selected ETFs to build a comprehensive portfolio might initially sound too easy to be effective, but hear me out. By meticulously selecting 3 ETFs that are designed to complement each other, you can rapidly create a portfolio that is well-rounded and strategically positioned for consistent, long-term growth. Furthermore, this minimalist approach dramatically reduces the annual drag of expense ratios. When you own fewer funds, it's significantly easier to track and manage the overall cost of your portfolio, ensuring more of your hard-earned returns stay in your pocket rather than going to fund managers. Lower costs, over decades, translate directly into greater wealth. So, what's the general consensus about robustly diversified portfolios? Well, most people are convinced you need to hold dozens of different assets to spread and mitigate risk effectively, and that's true to a degree. However, what's often overlooked is that many assets are highly correlated during a market downturn. This means that having too many similar investments doesn't necessarily reduce your risk during a crisis. In fact, having too many holdings can actually increase your risk in a couple of unexpected ways. For one, it can make your overall portfolio much harder to manage and rebalance efficiently. You'll have to meticulously keep track of all those different investments and their respective weights, which can be a real headache. And 2, it can potentially lead to a state known as over-diversification. This is when you spread your capital so thinly that you end up with merely average market returns across the board, rather than capitalizing on the standout performance from your core high-quality funds. The other practical issue with having too many varied assets is that it inevitably leads to higher transactional and management fees. Nearly all investments come with some kind of management or trading fee, and these seemingly small costs can collectively accumulate rapidly over decades. So, while the psychological idea of holding a lot of different assets might seem appealing or feel safer, it's demonstrably not always the optimal strategy for maximizing net returns. The focus should always be on acquiring a basket of high-quality funds that track global markets, not just accumulating a high quantity of tickers. Quality, comprehensive coverage of market segments, and low fees are the metrics that truly matter. Let's explore the 3 specific ETFs that I'm going to outline for this strategy. The first one is a total stock market ETF, which gives you broad, deep exposure to the entire US equity market, from small caps to mega cap tech. The second crucial component is a total international stock ETF, which provides essential access to stocks and companies from developed and emerging economies around the world. And the final piece is a total bond market ETF, which acts as a ballast to add some much-needed portfolio stability and fixed income diversification. These 3 ETFs, a US stock market ETF, an international stock ETF, and a total bond market ETF, can collectively provide surprisingly adequate and efficient diversification. The US stock market ETF provides exposure to some of the world's largest and most stable companies. The international ETF adds crucial global diversification, which can significantly help reduce your reliance on any one particular country or economy. And the bond market ETF provides a consistent fixed income stream, which can help smooth out the inevitable volatility within your equity holdings. The elegance of utilizing these 3 specific ETFs is that they create a simple mechanism to balance risk and potential return. The US stock market ETF provides substantial growth potential, while the total bond market ETF provides essential stability during economic downturns. And the international ETF adds a necessary mixture of both, offering growth potential alongside diversification benefits. This 3-fund model is not a revolutionary trading secret, but a core strategy endorsed by financial luminaries like Nobel laureate Eugene Fama and legendary investor Warren Buffett. It's built on the time-tested principle of owning a little bit of everything in the market, rather than trying to guess which individual company will win. The core principle here is to deliberately find the right asset allocation, balance that matches your specific risk tolerance and time horizon. And I firmly believe that this 3ETF framework can help most investors achieve that powerful balance. Of course, everyone's specific financial situation is unique, and what works perfectly for one person might require slight adjustments for another. But for the vast majority of long-term investors, I believe these 3 ETFs can serve as an exceptionally powerful and robust starting point. This foundational approach frees up your most valuable asset, your time. Instead of spending hours every month researching complex stock filings or market news, you can commit to a simple monthly contribution and focus your attention on your career, your family, or your personal well-being. By combining these 3 core low-cost ETFs, you can create a globally diversified portfolio that is perfectly tailored to your long-term wealth accumulation goals. And that's the main insight I want to share with you today. You absolutely do not need a lot of complicated hi-fi investments or a massive number of assets to achieve sophisticated diversification. With just 3 carefully chosen ETFs, you can create an incredibly solid foundation for your investment portfolio. To recap, the 3 ETFs I recommend cover the US stock market, the international stock market, and the total bond market. These funds provide deep, broad diversification and are designed to balance both risk and return effectively. And the best part is that they're remarkably simple to understand, manage, and rebalance annually. The benefits of embracing simplicity in your investing strategy can't be overstated, leading to powerful emotional and financial advantages. By keeping your portfolio uncomplicated and straightforward, you can save significant time, drastically reduce emotional stress during downturns, and minimize management fees. And who wouldn't want that kind of peace of mind with their wealth? This approach is especially powerful for those investing in tax-advantaged accounts like a Roth IRA or 401k, where the long-term impact of low fees and consistent compounding is maximized, pushing you closer to your financial independence goals every single year. If you've got any thoughts on this minimalist ETF investing strategy, I would truly love to hear them. Please drop a comment below and let me know what you think, or share your own set-it-and-forget-it portfolio. And if you're interested in learning more about practical low-cost investing, be sure to subscribe and check out my other videos for more insights and straightforward tips.